Hi everyone, so today we'll be talking about a pretty interesting topic, why global capital may be turning towards China. So recent data paints a pretty mixed but telling picture. So starting with jobs, annual revisions from the Bureau of Labor Statistics show that the US added 911,000 fewer jobs than previously reported, the largest downward revision on record. And over the summer months, payroll growth slowed to just 29,000 jobs per month, well below the level needed to keep unemployment steady. This confirms that the labor market is weakening, and with softer job creation comes slower income growth, clear signs of cooling demand. Now looking at PPI, which measures producer prices, the latest August print came in at negative 0.1% month over month, well below expectations for a rise, and core PPI was also down negative 0.1%. This shows cooling upstream cost pressures, hinting that demand is soft and companies are struggling to pass through price increases. That gives the Fed cover to start cutting rates. But CPI tells a different story. Headline CPI rose 0.4% month over month and 2.9% year over year, accelerating from 2.7%. Core CPI is still stuck at 3.1% year over year, and this suggests consumer prices are no longer falling much and might be bottoming out. Demand could be reviving even before any Fed cuts. Adding to this risk, new tariffs on imports and ongoing supply chain reshoring push costs higher, while tight housing and energy markets are keeping shelter and utility costs sticky. These structural pressures could drive CPI up again even without strong demand growth. And what does this mean for the Fed? They're expected to cut rates in September, mainly to support growth and prevent a recession as the labor market softens. And even though inflation hasn't fully returned to target, they might prioritize growth over price stability, accepting the risk of easing too soon. Holding rates high while the economy slows risks a harder landing, so they're likely to cut regardless. Cutting while inflation is still alive carries danger. Lower rates make borrowing cheaper and fuel demand. If CPI rises again after the cut, it would show inflation wasn't truly tamed, meaning the Fed stimulated the economy prematurely, potentially repeating the 1970s stop-go policy mistake. And this does matter for our outlook on 2026. Monetary policy works with a lag, usually 12 to 24 months. A September 2025 rate cut would hit the economy in 2026. And if CPI keeps rising, by then we could see, first, inflation becoming entrenched again, second, Fed credibility damage, third, sharp rate hikes needed, risking a hard landing, and fourth, even stagflation. High inflation with weak growth. So while a cut may look justified now, it could plant the seeds of a new inflation problem by 2026. Now, stepping back from the US macro backdrop and looking at the money flows. In August, something interesting happened. China's equity market flipped from an outflow of about 1.6 billion in July to an inflow of 5.5 billion. Clear reversal in sentiment. Meanwhile, inflows into the US and European equities actually slowed, showing fatigue after months of strength. On the fixed income side, capital is crowding back into US bonds. 85.9 billion in August versus 48 billion in July, while European bond inflows have started to decelerate. Overall, investors are getting more defensive globally, and some are starting to rotate selectively towards China. You can also see this rotation beneath the surface of US equities. Tech, which is the dominant leader of this cycle, saw over 2 billion of outflows in August. And at the same time, money moved into financials, materials, and staples, more cyclical and defensive sectors. That tells us investors are becoming more cautious at home, taking profits in crowded trades like tech, and quietly repositioning towards sector tied to the real economy. On top of that, we've also seen huge growth in safe havens such as gold and silver. This de-risking mindset is key because it sets the stage for capital to look abroad for new opportunities as well. And that search for new opportunities is starting to show up in the data. Within emerging markets, China is already the main driver of equity inflows. In August, China equity funds took in about 3.1 billion, while the entire EM complex combined only saw about 0.5 billion. On the bond side, China captured about 3.3 billion, nearly a third of all EM bond inflows. And this wasn't just active managers dipping their toes. Passive equity flows surged 12 times month over month, which matters because passive flows tend to be stickier. And even more striking, it's not just foreign capital driving this. Domestic Chinese investors also came back in force. Domestic flows swung from 6.2 billion outflow in July to 2.7 billion inflow in August. Foreign investors stayed net positive at 3.4 billion, and their active fund outflows have almost stopped, while passive inflows remain strong. This kind of alignment, where domestic and foreign capital are both buying at the same time, is rare, and it's often what you see at turning points, and that's why this is worth paying attention to. So what does all of this tell us? We've just seen that global capital is quietly rotating out of crowded US trades into more defensive or under-owned areas, as well as safe havens such as gold and silver. I believe China will be one of the first places starting to attract that capital again in terms of equities. And importantly, this isn't just a one-off data blip. It's happening against the backdrop of a weakening US labor market, slowing global growth, and rising pressure on central banks to cut rates. In other words, the environment is shifting from one driven by US exceptionalism to one driven by relative opportunity. That brings us to our key question. If money is beginning to move, where could it actually stick and grow over the next several years? This is where I want to zoom in on China, because beyond this short-term sentiment reversal, there are deeper structural reasons why Chinese equities could be well positioned for the medium to long term. First, let's talk about where China is in its policy cycle and why it's ahead of the US. First, what the policies are. Since mid-2023, China has been steadily rolling out monetary and fiscal easing to support growth. On the monetary side, the PBOC has cut key policy rates, including the 7-day reverse repo rate and the 1-year loan prime rate, and lowered banks' reverse requirement ratio multiple times, releasing long-term liquidity into the system. They've also launched target tools like an RMB 500 billion swap facility and an RMB 300 billion relending program to direct credit towards tech, SMEs, and housing. On the fiscal side, Beijing has accelerated the issuance of special sovereign bonds, front-loading spending to stimulate demand. These measures together mark a clear pivot towards growth support. Second, where does this fit in the policy cycle? In a typical cycle, central banks first tighten policy to fight inflation, then pause, and finally ease once growth weakens. China is already well into that easing phase. Interest rates are coming down, liquidity is being injected, and credit conditions are loosening. The US, on the other hand, is still at the tail end of its tightening phase. The Fed has kept rates high to battle sticky inflation, and while it has signaled cuts are coming, they actually haven't started easing yet. Third, where it's headed. Because monetary policy works with a lag, China's easing will likely flow through the real economy over 2025 and 2026. With inflation still very low and growth under pressure, Beijing has room to keep cutting rates and expanding fiscal support if needed. Politburo's statements have shifted towards describing conditions as moderately loose, and regulators are explicitly pushing to strengthen capital markets and boost risk appetite. This suggests policy will stay growth-oriented until the recovery gains traction. And finally, why is this ahead of the US? The Fed is expected to begin cutting rates in late 2025, or this week even, meaning the US is only just approaching its pivot point, while China has already been easing for over a year. This means the growth impulse from China's policy support will likely appear just as US growth is cooling. In other words, the two are on opposite ends of the cycle. The US still at peak restrictive policy, and China already entering early cycle conditions, which is a major reason global capital is starting to rotate back towards Chinese markets. Next, let's look at China's position in global supply chains and how it's evolving. First, why is its grip so strong? China has built unmatched scale and efficiency across manufacturing. It's the largest global exporter of electronics, autos, solar panels, and apparel, and it's often something competitors can't replicate easily. Dense, fully integrated supply clusters. That means suppliers, skilled labor, logistics, and infrastructure are all located, which cuts costs and speeds production. Beyond that, China controls critical upstream inputs. For example, it produces about 75% of the world's lithium-ion batteries, 90% of rare earth elements, and 95% of rare earth magnets, which are essential for EVs and electronics. Decades of state support and subsidies help build this ecosystem. And even when companies move final assembly to places like Vietnam or India, they often still rely on Chinese-made components. Even so-called non-China supply chains are still deeply China-dependent. Looking ahead though, the landscape is shifting. We're seeing some diversification of final assembly to Vietnam, India, and Mexico, especially in electronics and apparel. But this diversification is still shallow. Many of these new hubs rely on Chinese parts and machinery, and Chinese firms are actually leading much of the investment building those factories. So China plus one often still means China-backed. Policy will be the key driver of how far this goes. US tariffs and industrial policies, European de-risking efforts, and Indian and Vietnamese subsidies are all pushing companies to diversify. But as long as tariff gaps stay modest, many will still stick with China's stable and complete ecosystem. Meanwhile, China is doubling down on strategic sectors, especially the so-called new three: EVs, batteries, and solar PV. It's already controlling over 80% of the global solar supply chain and about half of the EV market. And these industries where global demand is guaranteed by the energy transition. So the bottom line is, supply chains are becoming more regionalized and politically shaped. But China is likely to stay the central node for high-value inputs, rather than full decoupling. What we're seeing is more of a China plus one model, where production footprints diversify geographically, but remains anchored to China at their core. Next, in China today, household wealth is highly concentrated. Roughly 60% sit in real estate, about 25% in cash and deposits, while equities only account for around 5% of household assets. That's a stark contrast to other major markets, where equities make up about 25% in the US, 12% in Europe, and 7% in India. But this structure is now being challenged. After years of decline, the property sector has become a less attractive investment option, and successive deposit rate cuts since 2023 have reduced the appeal of bank savings. Under China's new economic landscape, the equity market could take on a much larger role as a household wealth reservoir. A stronger stock market can also create a wealth effect that supports consumption, which is a core policy goal. We've seen this dynamic before. Household allocations to stocks tend to rise during market rallies. According to JP Morgan's estimates, onshore household stock allocation hit 10% or more during major market peaks in 2007 to 2015 and 2020. So for this structural shift to stick, market performance, corporate quality, and investor protections are critical. That's where policy comes in. Beijing is now making a concentrated and concrete push to build a high-quality capital market. In April 2024, the State Council launched the 9 measures designed to enhance capital market supervision, improve operational efficiency, and increase shareholder returns. Listed companies are being encouraged to raise dividends and offer cheap bank loans at around 2.25% interest to fund share buybacks. In September 2024, the PBOC also introduced 500 billion RMB in swap facilities and 300 billion RMB in re-lending programs to support market liquidity and resilience. The backdrop is a huge pool of idle household savings. Household financial assets grew by about 18 trillion RMB per year in 2022 to 2023, but most of that flowed into deposits such as equity returns disappointed. And by September 2024, household deposits hit 150 trillion RMB, larger than both China's 2023 GDP and the total A-share market cap, which was about 98 trillion RMB. The run rate of new deposits had already slowed to about 1.3 trillion RMB per month in 2024, down from 1.5 trillion RMB in 2022, showing deposits may be reaching saturation. As deposit rates fall and stock returns pick up, this money could start to shift. If household allocation to equities just returns to 2020 and 2021 levels, we could see 2 to 3 trillion RMB of inflows from retail investors, about the same scale as the average annual inflows into equities and equity funds during 2020 to 2021 period. That's a huge potential tailwind for the market, and we've already seen the first signs of this. The market rallied sharply at the end of September, driven by these supportive policies. On October 8th, the first trading day after the national holiday, A-shares turnover hit a record 3.5 trillion RMB, and margin financing balances surged to 1.75 trillion RMB, the highest since 2023. This shows retail sentiment is coming back, with new retail accounts and institutions re-entering the market. So overall, what we're seeing is a structural shift. A prolonged property downturn and falling deposit returns are pushing policymakers to build equities into a second wealth reservoir. And with policy incentives, large household cash pools, and returning retail participation, this household asset rebalancing could become a long-term driver for Chinese stock market. Lastly, we're going to talk about the valuation gap between China's leading tech names, China Tech 10, and the US Mag 7. What stands out is just how much cheaper China's tech sector has become relative to its US peers. While US giants like Alphabet are currently trading at around 25 to 26 times forward earnings, Microsoft at 30, and Nvidia above 35, Chinese leaders are at a much lower multiple. Tencent sits around 18.6, and Alibaba is only about 8.6, which is less than half of its own 5-year average of 18 times. Broader indices tell the same story. MSCI China is at about 11 to 12 times forward PE versus 20 to 21 times for MSCI US or the S&P 500. Over the past few years, this valuation gap has been persistent. US Mag 7 names have mostly hovered in the mid-20s to low 30s, while China Tech has steadily compressed into the mid-teens and sometimes lower. On the return side, China Tech has underperformed meaningfully over the past 5 years, while US Tech surged. Yet this year alone, China Tech has actually tracked or even outpaced US peers at various points, despite that much lower starting valuation base. And this trend isn't just limited to the tech sector. It's broadly representative of the Chinese equity market as a whole. Across the A-share and Hong Kong markets, many sectors are trading at high single to low teens for PE, far below the 20 times plus multiples seen in the US, and even below historical norms for China. In other words, the market is broadly priced for lower growth and high risk, which creates a margin of safety. If earnings growth in China improves, which seems increasingly plausible given the policy support and early signs of recovery, then equity upside could come not just from earnings growth, but also from multiple re-ratings. Investors don't need China to suddenly trade at US-style valuations for there to be upside. Even moving from 15 times back to 20 times could re-rate the market meaningfully. Of course, there are still risks. Regulatory shifts and global macro headwinds remain real overhangs, but this valuation gap shows that a lot of pessimism is already priced in, while any improvement in sentiment or earnings could unlock significant upside. And on the last point, China's long-term growth story isn't just about macro recovery. It's being underpinned by real sector strength. Two sectors in particular stands out for me. Technology, where China remains a global manufacturing and innovation powerhouse, and innovative pharmaceuticals, which has quietly become one of the fastest growing biotech ecosystems in the world. Starting with tech, China has long been a global hardware powerhouse, producing over 65% of the world's laptops and nearly half of all smartphones, while also dominating EVs and batteries with roughly half of global EV sales and around 75% of battery capacity. But what really excites me now is the momentum in AI. This year, Chinese AI stocks have surged, with the CSI AI index up about 60% year to date, far outpacing the broader market. A big catalyst has been DeepSeek, a homegrown open-weight AI model that sparked a wave of investor enthusiasm and accelerated AI adoption by firms like Baidu, Tencent, and Alibaba, and also Huawei. This shows China is no longer just following in AI, it's beginning to lead. And importantly, this rise is built on deep foundations. China now spends over 2.6% of GDP on R&D, more than the EU, with a heavy concentration in chips, AI infrastructure, EVs, and renewables. Combined with large-scale talent, world-class data centers, and strong state support under the new quality productive forces strategy, China has the ingredients to become a long-term leader in AI and advanced tech. Pharmaceuticals tells a similar story of rapid rise. China's innovative drug sector has become one of the strongest in the world, basically number one now in terms of new drug pipelines and approvals. Over the past few years, we've seen a surge in IND filings, clinical trials, and first-in-class drug development, driven by companies like BeiGene, Innovent, and Junshi. They've moved well beyond generic production into cutting-edge areas like oncology, immunology, and cell therapy. This has been enabled by fast regulatory reforms, which has dramatically shortened approval timelines and strengthened IP protections, and by improved commercialization pathways, with Chinese firms increasingly licensing drugs to global pharma majors. BeiGene, for example, generated over $3.8 billion in global revenue last year and now operates on a truly international footprint. Together, tech and pharma are two sectors where China isn't just catching up. It's building clear leadership positions. They offer structural earnings growth, global competitiveness, and represent areas largely insulated from the property cycle, making them powerful long-term drivers for the Chinese equity market. So if you found this helpful, please hit like and subscribe so you don't miss the next video. And if you want to keep the conversation going, join our investment community on WhatsApp, where I'll be sharing additional insights and discussing ideas in real time. Thanks for watching, and I'll see you in the next one.